We know that it's not exactly easy to get credit in this country unless you're already wealthy. And all this talk about multiple rate hikes from the Fed will only make it harder to borrow money. So what do we do with a company like LendingTree, the online lending exchange that connects consumers with banks, especially for mortgages? LendingTree reported what looked like a solid quarter earlier this month, but the stock's been hammered of late. And just to be clear, this is a totally legitimate business that's not to be confused with Lending Club, the now scandal-ridden peer-to-peer lending play. Can LendingTree thrive in an environment where credit might even get tighter? Let's check in with Doug Lebda. He's the founder, chairman, and CEO of LendingTree. Doug, kind of shocked here. 72 to 76% growth you're forecasting? How can you do that in this environment?
Our growth is actually up about 80% year over year, both on revenue and the bottom line. And it's happening because the online lending business is really taking off. And as a marketplace, as a matchmaker with over 300 lenders, lenders are finally getting automated and the industry is growing like a weed.
The mortgage market, we are concerned very much on the network. One hike may be okay. Two, three. I mean, that's going to hurt the business.
It will hurt the overall business, particularly in refinancing. However, LendingTree has grown despite declining originations over the last 5 years because, very similar to the hotel business and travel, lenders bid up the value of LendingTree when they need extra volume, and that's when we can serve them the best.
I could not believe that you brought, in your unbelievably transparent conference call, one for the books, frankly.
Hey.
You brought up Lending Club. You brought up the issues. You brought how much it can hurt you and not that much, and that there are others who are going to take the slack up. Can you just explain to our viewers what you said? Because I thought it was the most honest depiction of the impact on your business.
Absolutely. So first, Lending Club and others are doing what lenders have done for years, except they're much more automated. And Lending Club obviously had an issue with internal compliance.
Right.
Other lenders might have issues with credit from time to time, et cetera. But Lending Club is one of 300 lenders on our network. I think they're very well run. I think Scott Sanborn, their new CEO, is a great guy. I think they're going to be fine, but they're going to need to compete against guys like Citi and Chase and Wells and On Deck and everybody else.
Now, you gave a great example. This is kind of like Expedia Priceline in a merged airline business. There's still plenty of business to do.
You got it. It's exactly the same thing. We have 30 lenders on personal loans, and we've got a lot more coming on board now who are mostly big banks, who are non-bank mortgage companies, who are moving into personal loans with very, very stable sources of capital.
It's in the Lending Club's DNA. I mean, I thought it was very interesting. You said that a lot of those guys really understood and came of age when you did. The older banks know. So what's bringing them in?
What's bringing them in now is really automation. So we, for example, work with big national banks who say to us, we just want to see customers of ours who are actually shopping on your site. Because they don't necessarily want to refinance them themselves, but if they know customers are shopping, they want access to those customers. So we basically save lenders money from marketing, and that's the whole deal.
All right. Now, we earlier had Spencer Rascoff on this week, Zillow. I was talking to him about some of his growth businesses. Doug, it's the one that competes against you. He's determined to try to take your business.
He absolutely, Zillow will do a great job in mortgage. They have. Lenders typically like either a Zillow type of a rate table model, or they like more of a matching and more of a lead model. We actually have both, but Zillow is going to be an interesting competitor, and they do a very good job in real estate. But the important thing for us is we're not just mortgage; we're also personal loans, credit cards, home equity, auto, et cetera.
I want to mention auto. A lot of people think auto is a bubble. Are there any bubbles in any of yours? Because I'm talking about bubbles tonight. I don't see bubbles anywhere in the economy, but maybe you can fill me in.
I think there are bubbles only in the private company valuations.
And there's a coming down.
Those are coming down. But other than that, I know our stock, I believe, is very fairly valued. We're buying it. I'm buying it. I'm not seeing bubbles in lending in general. I think now it's getting much more competitive.
We're buying. I'm buying. You're in the market buying because I know that there's still 12.9 million shares. You've been buying back stock, but it's actually going up, the amount of shares. But you personally and your company are in.
Yes, absolutely. We have a huge buyback that's underway. I recently paid cash taxes for restricted stock and bought 5,000 shares actually last week. A number of our executives did as well. We think now's the time.
All right, Doug, very publicly, I'm looking at an article about Donald Trump. LendingTree founder backs Donald Trump. You think it'll be good for business? A lot of people are concerned.
I actually do. I was actually a supporter of Ben Carson during the primaries, and a lot of the people that worked with Carson came over to work with Trump. And I certainly think he's going to be better than Hillary Clinton, and I think he would be very good for business. So that's why I'm on board.
But Hillary Clinton speaks for people who may not be all that wealthy, who have been would be clients of LendingTree. Why wouldn't she be terrific?
I think Donald Trump speaks for the working class as well, and I grew up in Pennsylvania and know those people well, and we want to save them money, and I think he's going to be the best for the country.
All right, let me go back to this lending club issue. You think that was an issue for a couple companies. Are other companies still getting in that business? Because it's a good business if you do it right.
It is. And as a matter of fact, your old place, Goldman Sachs, has actually publicly announced that they're going to be entering the personal loan business. Discover is entering the personal loan business, and they're going to do a great job. Companies like Quicken Loans are entering the business. Loan Depot is entering the business. So done right, it can be a very profitable business, and any lender lives or dies on their underwriting. If they write bad loans that end up defaulting, they're obviously going to have capital problems. This is just like mortgage companies have faced since Ranieri invented the bond.
No, I like your hedge fund example. That's like a hedge fund that goes, you don't sell the NASDAQ stock because the hedge fund gets in trouble.
You got it.
All right, last question. You have been at this for a long time, but when I look at the income, it was, and then boom, what changed to make it so that it went just soared?
So the change is because internet lending today is where travel was in 2001, because now the lenders have automation. They're focused on it. They can get good conversion rates from a customer to a closed loan, which is increasing our revenue per customer, which enables us to step on the marketing gas.
Well, I don't understand why the stock's down other than guilt by innocence, but guilt by association because of a lending and a lending. That's Doug Lebda, the founder, chairman, and CEO of LendingTree. Stay with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.